Bitcoin just absorbed a liquidation wave, while capital rotated defensively into stablecoins. And at the same time, Coinbase heads into a White House meeting on Monday with banking and crypto leaders to try to unblock the stalled crypto legislation. And right at the center of that conversation is stablecoin yield. For investors, here is what changes. The move you're seeing in price is largely mechanical. We'll get into more of that in today's video. What comes next will be shaped by policy decisions that directly influence liquidity and capital flows. So today we're going to keep it tight. We're going to talk about what caused the drop, what the market is signaling right now, and what to watch next so you're prepared when opportunity shows up. Now remember, my videos are for educational purposes only and not financial advice. Let's get into it. So let's get started with what actually caused the drop. Let's start with the mechanics. Bitcoin lost its prior holding range and slid into the low 80,000s range. When a widely watched support breaks, behavior shifts fast. Buyers pause, stops trigger, and weak hands exit. Then, of course, the accelerant kicks in. Leverage. Liquidation surged to roughly $1.7 billion. With about $1.59 billion coming from long positions being forced out. That's why the move felt one way. This selling was not emotional. It was not discretionary. It was automatic. Margin systems closing positions into a failing market. That's how overshoots happen. Liquidation waves don't wait for fair value. They clear positioning first. So where is capital going? When crypto turns unstable, money often rotates into stablecoins, especially USDT. That shows up as a rising stablecoin dominance, meaning a larger share of capital is parked defensively instead of chasing risk. And right now, stablecoin dominance is turning back up after pullback. And near term, that signals hesitation. Capital is waiting, it's not bidding. And you'll hear analysts reference tools like the bull market support bands, which is simply a long-term trend zone built from moving averages. When price holds it, trend support remains intact. When dominance rises alongside it, it signals defensive positioning. Some are also pointing to an area around 8% USDT dominance, which often aligns with continued caution. So that's not a forecast, it's a scoreboard. And the message is consistent. Capital is sidelined and waiting for clarity. And this didn't just happen to crypto. Here is why Bitcoin felt especially heavy. And that's because the entire tape de-risked at once. Over the last 24 hours, gold dropped roughly 10.9%, erasing about $4.1 trillion. Silver fell around 21.5%, erasing $1.4 trillion as well. Bitcoin, however, declined roughly 6.6%, wiping out about $108 billion. And Ethereum fell about 7.5%, erasing roughly $25 billion. So in total, more than $6.5 trillion disappeared across metals, equities, and crypto in a single day. That's what synchronized risk-off looks like. In those moments, Bitcoin trades like a high beta liquidity asset. When the system de-risks, crypto doesn't get spared, it gets amplified. Now, let's layer in politics, the one element many people undermine. We see that Washington is actively moving on crypto market structure. The Senate Agricultural Committee advanced a market structure bill, which is essentially the U.S. crypto rulebook. It defines who regulates what, how assets are classified, and what rules exchanges operate under. The key shift is expanding the CFTC's role, including authority over spot commodities like Bitcoin. Now that's progress. And it's not final. The bill still needs alignment with the SEC side and additional votes. So the takeaway here is momentum, not closure. Things are moving. And momentum, we know, changes behavior. It reduces headline risk. It makes institutional allocation easier. And it reshapes who builds, who lists, and who provides liquidity. Now, let us go straight to the pressure point. That is stablecoin yield. Coinbase will be in the room at Monday's White House meeting as regulators, banks, and crypto firms try to resolve the stalled legislation as it has been. And the sticking issue is whether compliant stablecoins can offer yield, of course, because this puts them in direct competition with banks, which you would know if you watched my yesterday's video, which I entirely encourage you to go watch, because it really paints the picture in the backdrop of what is going on a key relational level, I would say, between all the major powers in the world, financial powers. And we know that stablecoins are a huge threat to central banks because it's cash essentially competing with new cash. Stablecoins are a dollar-like instrument that can pay something without exposure to volatile assets. And if allowed to coexist and do business openly, stablecoins alter flows, they make liquidity stickier, and they shift who controls deposits. That's why banks are pushing back so hard. If deposits migrate from banks into yield-bearing stablecoins, that's not a crypto headline. That's pressure on the banking system's very foundation of existence. And we see that crypto-aligned political groups have raised tens of millions of dollars recently and reportedly have close to $200 million heading into the midterms. In a tight election cycle, this kind of capital accelerates meetings, compromises, and timelines. So that's also why Monday carries so much weight. This is a negotiation over whether digital dollars are allowed to compete directly with traditional deposits with traditional banks. Now, let us zoom out and gain some perspective, because drawdowns always feel unprecedented in real time. However, history shows us they rarely are. On a longer-term view, Bitcoin versus the Nasdaq barely registers as abnormal. Actually, we saw similar stretches in 2015 and 2020, where equities moved first and Bitcoin lagged before catching up in sharp bursts. And the same pattern shows up against global liquidity measures. Liquidity leads, Bitcoin lags, then Bitcoin responds once forced selling clears. That's why patience here is strategic, not passive. It's essential for your success, actually. And if we take a look under the hood, one more mechanical factor during stress are miners, because recent data shows Bitcoin miners' production cost has dropped to around $69,000, with electrical cost closer to $55,000. So this widens the range of plausible downside during stress events. Now, this doesn't imply price must go there, but it does mean when the system is fragile, volatility explores a wider range. Now, here is the quiet bullish offset. Here's what's very easy to miss. Long-term holders have stopped distributing. Realized profit from coins held 4 years or longer just hit its lowest level since 2024. Long-term holders are often the supply that caps rallies. When they stop selling, overhead supply thins. And once conditions stabilize, this means price can move faster than most people expect. So be looking out for that. And here is what investors should be watching next. Let's get very practical. After liquidation events, relief bounces are common. A widely watched resistance zone sits near 87,000, where prior support often turns into resistance. If weakness continues, the $70,000 range tends to be an area where volatility expands. Deeper conversations often center around the $55,000 range, $65,000 zone. And on the upside, reclaiming $91,150 is an early sign of strength returning, so we have to be watching for that as well, with stronger confirmation sitting above $98,000. These are regime markers, not trade triggers. They should help you read whether the market is stabilizing or still under pressure. And as we close out today's video, I know these times can feel volatile and very uncomfortable and uncertain. But this is what being early feels like. What we just saw was a forced flush. The fuse is Washington. So if you stay patient, focus on the signals, and think like an investor with a longer term horizon, you give yourself the best chance to navigate the next phase when the market stops playing defense. Because the market is going to rally. And if you've been in crypto for some time, you know this. I don't have to tell you. But if you're new, welcome to my channel, and I would encourage you to go watch some of my past videos. Let me know in the comments if you're new, and I'll point you in the right direction, because there are so many reasons as to why this year is going to be bullish. And I'd be so happy to remind you if you need me to. So that's a wrap for today's video and for the week. And if today's video helped you see the board and the big picture more clearly, like the video and share it with a friend or family member, because that means so much to me that we help spread the word and spread awareness on financial sovereignty, because it will be linked to your individual rights in the near future. I love you guys so much, and I'll catch you guys here on Monday. Take care. And then just quickly, for all of you who made it to the very end, thank you so much. I just wanted to soft announce a new channel I'm launching. It's called The Heat Method. I have not produced a video yet, but it is coming soon. And it's where I'll be sharing my personally backed experience and philosophy in dating and having a really happy, flourishing relationship, which frankly, I think you can take into other areas of your life. So that channel is coming soon, and I just wanted to let you guys know in advance. And I'll be dropping the link to my new website, which is still a work in progress, but it's at least live. And I'll be also linking my new YouTube channel down below for those of you who are interested in coaching or my group classes. They're all coming soon. All right, I'll catch you guys here on Monday.